AM 1220 KDOW and Money 2.0 present The Real Estate Report with Tony Mendez and Gordon Hines. Bay Area real estate and mortgage experts with over 25 years in the business. Now, with an in-depth look at this week's local and national real estate news and what it means for you. Your hosts, Tony Mendez and Gordon Hines.
Welcome in, campers. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for joining us. The first show of 2021. I can't believe it's already 2021.
I can believe it because I'm sure I'm glad and happy is here. I can tell you that much.
Oh my goodness, that was a strange year. I think the strangest year on record for a lot of people. Even my dad. My dad's 77 years old, and I've never seen anything like it. He hasn't left his building since March. He's in a facility. He hasn't left in March, and they can go for walks, but they have to be supervised. If he's not supervised and he leaves, and he comes back, he has to be quarantined in his room for 2 weeks. So imagine that, in every old folks' home in the United States. It's crazy. My dad said nothing like this has ever happened in his life, and he was born in 1943.
Yeah, I mean, a lot of people complain about shelter in place. It can actually lead to depression. People not going out. That's why a lot of people actually breaking the rules. Believe it or not, some people say they rather risk going out than to be depressed in a place all shut up. It's kind of interesting. Every time, like we always say on the show, right now, a lot of tough questions, no easy answers. Yes?
Yeah, that's very true. That's why, if you have questions, it's kind of a weird segue into real estate, but if you have questions, that's what we're here for. You call the show 800-516-1220, 800-516-1220, or shoot us an email, Tony or Gordon at bayarealoansource.com. That's also where you can sign up for the newsletter that we get out as often as we can. We're going to be a little bit more active with that this year. Because there's new news keeps popping up, like the conforming limits. Those got increased. And what does that mean to you? I think that was a great ending as far as mortgages, even though they added on that 0.5% fee from the Federal Housing Finance Agency called an adverse fee. And it did, it kind of played itself out, and rates kind of went up, and then they came back down to all-time lows. But it is a great place to hear and get news from, our newsletter. But the conforming limits was a great way to end the year.
And actually, believe it or not, we actually started earlier. Typically, we waited till the first year to start it. They would announce it at the latter part of the year like they normally do. But this particular year, which was last year, not only did they announce it, they put it into place immediately, which kind of gave the market an extra kick or an extra bump that we actually need to kind of take us through that tough times.
I'll give you the perfect example of how conforming limits can help you. We're working with a client right now who's in San Bernardino County. If you pull the zip code, their conforming limit is only $705,000 on what they call high balance. And this person's doing a $780,000 loan. So they fall into jumbo. They're going to get a rate. They've been offered this by a couple banks, 2.625% with 2 points. Now, plus closing costs, 2 points plus closing costs. And now, if you're conforming, you can get that, with a good credit score, good equity, which this person has. Even with a good equity and good credit score, that's what they're paying for jumbo. That's what you're trying to avoid by getting in a conforming limit. So in the Bay Area, the high balance limit right now for most counties is $822,375. For regular balance is $548,250. So when you fall under those limits, it gives you the better rates and the better guidelines. For example, last year's W-2 and a paycheck. If you're W-2'd, it's and a bank, and then you have your couple bank statements, a mortgage statement, homeowner's insurance, and a driver's license. You're done. That's what most W-2 people that are doing, unless you own a whole bunch of property or you get K-1 income, things like that. That's what most people are getting with these conforming loans. Those are the kind of guidelines.
Well, those are the cookie cutter loans. Those are loans that are simple. Those are loans that are not very challenging for an underwriter. You basically work one job for 10 years, got a 750 credit score, loan to value below 90%. Those are typically what we call cookie cutter loans, slam dunk loans, the loans that we can close in our sleep. Some of the loans that we do, of course, are self-employed people that are 1099, people that were using deferred assets to come up with income. People that are fixed income borrowers, all kinds of different challenges that come into play that you have to kind of really work through the income to actually come up with an actually viable number that all parties can live with, because everybody kind of look at things different to make that person qualify. So it's a little bit challenging. Sometimes those loans take a little bit longer.
Yeah, but if you still fall in those guidelines,
you're still
going to get the rate.
You're still good.
So your situation is what it is. And luckily, by falling into the conforming limits, you can fall into where the majority of the people in the United States, 86% of people are getting these types of loans with Fannie Mae or Freddie Mac or FHA, VA, USDA. That's why you get the low rate. It might be a little harder in some cases. Like during COVID, they had the CARES Act, and the buyback rules from these lenders was crazy. And the investors were saying, you know what, if you're taking cash out, or it's an investment property, or a second home, or anything that's weird, or it's a duplex, anything that's weird on the loan, we want our money now. So they started charging a little bit extra fees up front, because you could theoretically turn that button on and go right into forbearance and not get their money. So a lot of these, if you fall into that cookie cutter, great. If you're not, you're a little bit higher, but you're still following the better guidelines.
And that's one of the reasons why, too, in a volume type situation, when market's really busy, it takes much longer to underwrite some of those loans. Some investors right now are actually offering incentives for the cookie cutter loans, because
we just got one
they can do more volume, and they can be more effective as far as cleaning their pipeline, and as we call in real estate, days on the market, days to closing. And so everybody's trying to find the edge, and every investor is trying to find the edge. Everybody wants to take advantage of the market. Market's busy, rates are low, people are refinancing, people are buying properties. The early part of the year, people are doing a lot of tax planning, and they're just trying to gear up for volume to make sure they're competitive.
Well, I don't think it's just that. I think they created a new product. They created a new category. Here are the people who are W-2'd, one property, and we're going to give them an incentive. So if you're self-employed, you don't get it. But so it's because they're not discriminating. They just created a new product that an investor is buying. And they're able to sell this at AAA paper.
Well, I'm not sure. Maybe a smart attorney can actually dissect that and say, wait a minute, does my borrower qualify, yes or no? If he doesn't qualify, you're penalizing him because he's self-employed, but he's paying taxes just like the person on W-2 on a pay stub, right? His debt to income ratio is the same. So why would he be burdened with a higher cost because he's self-employed?
You could say the same thing about people who are getting appraisal waivers and the people who aren't.
Well, I mean, appraisal waivers based on what we call...
Who is it that Fannie Mae or Freddie Mac can say, well, we can waive your appraisal, but not this guy?
Well, that's the investor.
It could be the neighbor.
It's the investor. So they decide what products they're going to do. As long as it's not discriminatory. I don't think an appraisal waiver is a discriminatory act. It's just a benefit of having a loan in the system in which the value is actually recognized. So if you look at things on a level playing field, you can always dictate and slice and dice. We always got to make sure we're all good on the same page, because that's where discriminatory actions come into play later on down the line.
Well, when it's all said and done, a lot of 2020, we started the year somewhere around 3.7 and ended it.
In the twos.
Sorry, I dropped it. 2.65% was the average rate last week for Freddie Mac's weekly survey ending January 7th. Oh, that was today, January 7th. 2.65%. 15 years, 2.16%. So the year was fantastic. Just kept going down. Now, the next week's results are going to go up a little bit, because through, we had the Georgia elections. Democrats kind of took that and pushed through the stimulus package. Markets reacted. The 10-year yield went up. Mortgage rates went up a little bit. Still, we're bouncing off of lows, but we're not quite there right now because of the market. So it's still a great opportunity for people to look at refinancing and purchasing, of course, whether it's taking cash out or whether you're paying off credit cards or you're taking cash out for an ADU. We have a lot of people looking to buy and take advantage of these low rates and buy investment properties. They might have a free and clear property and take a couple $100,000 out and get a low rate on an investment property and start spreading the money around a little bit.
Well, that's one of the products that we've been pushing a lot. We always counsel people on actually best to take cash out, especially if you're in a relatively new loan, meaning gotten to that loan in less than 5 years ago. You're not going to pay that thing off. Depends on your age. If you're 45 years old, 50 years old, you're not going to pay off a 30-year loan and still be applicable and thinking about it. So we also look, if you have a chance to refinance, take cash out, keep your payments the same. That can actually be a great benefit, especially in times we know there's turbulence ahead. It's always good to have cash on hand. It's always good to be prepared. That's what the Boy Scouts always say.
You've dabbled in your own taxes for many, many years, Gordon. And what do you think of this question? We've had people who have had a free and clear property or very little loan, a lot of equity, taken money out of their primary residence and bought a free and clear, or maybe got a loan bought a rental property. And they're wondering how to write off the taxes. We've seen tax returns where people, instead of writing off the interest on their primary residence, which, by the way, can get kind of dicey because go read the rules. If you read the rules, even though a lot of people still do it, you're not supposed to be writing off that interest on your Schedule A. You should be writing. So what we're seeing are people writing off that interest on their Schedule E, even though it's on their primary residence. Do you agree with that?
Well, I mean,
I know it's a tough question because taxes are one of those things we're not supposed to talk about, but
well, the tax code is written for interpretation. If you ever challenge, as long as you can have a viable argument, you have a good shot at being not able to pay taxes. But if you read the IRS code, the IRS guidelines, they specifically have specific guidelines on what you can and can't write off. A lot of people, of course, don't get by it, if we call it. It's just like speeding, for example. People speed all the time, but when you get caught, now you have to pay. Same thing with filing taxes. I've seen some very, very creative tax returns in my business. I've seen tax returns that makes no sense, but they never get caught, so the person thinks that they're actually beating the system. But if they ever got caught, sometimes the taxes are so outrageous, it can actually go into tax evasion, which is another set of laws. So you always got to be careful what you apply for. Make sure you talk to a qualified person that can give you qualified information rather than Cousin Vinny.
Yep. Yeah, you have to surround yourself, especially if you start accumulating a lot of assets, in this case, real estate. You have to surround yourself with professionals. Now, you can go to a mortgage person and get a mortgage, but you got to have the other people on the other side to start really, managing all of those financial, especially the liabilities that go along with it. And taxes are a liability that nobody really wants to get in trouble with. We see it all the time. Unfortunately, we see it more often than not. I mean, you just had a client come in the other day that had how many? It was like $50,000 lien on his title report, which
back taxes.
And now he has two choices: he can pay them, or he can pay it off. Well, either way, he's going to pay it, or he can try to negotiate with the IRS. But that became a lien on his property.
And that was one of the things that I told him the reason why he didn't catch it is because we changed the rules, I think, the early part of the year where the IRS no longer reports these liens on your credit report. Normally, he would have known about this lien, at least to me, would have known it, because we normally report it as a tax lien on the credit report. Since they got rid of that, so now the same lien is still available. It follows his name. He's got two properties, so both of those properties now are burdened with those tax liens, and he has to get those cleared up if he wants to move forward.
So he's got to get a payoff of some sort.
Absolutely, get him cleared
from the
up.
IRS so that he can pay that off. He doesn't really want to go to a payment plan because that doesn't get it off the lien.
Plus the interest is you're paying.
Yeah, the penalties. You don't want to do that. You want to pay it off. Luckily, there's some equity that you can do. You can do that in a transaction. So we've done them multiple times. All right, we'll come back after this break. I'm Tony Bennett. That's Gordon Hines. You can always call the show when we're back, 800-516-1220. That's 800-516-1220. Or email the show, Tony or Gordon at BayAreaLoanSource.com. We'll be right back here on AM 1220 KDOW.
Questions about real estate? Call the program, 800-516-1220. Now, back to the Real Estate Report on AM 1220 KDOW.
I've been in the right place, but it must have been wrong.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for joining us today. Mortgage rates bipped up a little bit after the markets reacted to the elections in Georgia. The Democrats taking a little bit more rule in the Congress, and they're pushing through that stimulus. I'm not sure if that stimulus really warranted the markets reacting the way they did, but I think we're still going to have some turmoil and a lot of volatility throughout the year, and we're going to see the rates up and down, up and down. We talked last week about some of the predictions that some of the big organizations out there and lenders and other financial institutions were saying, anywhere between 3 and 3.5% was the consensus. Nobody really said they were going to stay below 2%. So we're not saying this is your last opportunity to get a refinance and get these rates below 3, but it might be an opportunity to finally get that and just be aggressive and just do it. Because in order to get it below 3%, if rates are at 3.25 on average, you're going to have to be really aggressive to get it below 3%. So we're not putting words in your mouth. We're just doing the math.
Well, rates are timestamp, as we always say. It's hard, very difficult to time the market. We always use the clause as far as the stock market is concerned. If you want to get rich in the market, buy low and sell high. The problem is when is low and when is high. Same thing in rates. Rates change all the time. The economy does things. Different things causes rates to go up and go down. In a market where there's a lot of volatility, with a lot of action, we have these rates low for a specific period of time because of it helps the market. But as the market recovers, we need to kind of get over the inflation portion, and you'll see the Fed artificially doing changes to the rate to make the market kind of balance itself out. So rates might go up in a short-time basis and come back down the following month, but you'll see those changes. Sometimes people start to panic when they see the rates going up because they're unsure about what they should have done, could have, should have, would have, and then you start that panic, what we call a panic sale. People are rushing to get what they can't done because the market is finally moving upward. Yes?
Yeah, totally agree. And, we've heard the Fed talk about how they want to keep their Fed rates low. So to incite some more inflation, and they want to see it. They set the target a little bit higher. With that said, low interest rates have given a lot of people questions about what to do with real estate. It's getting a lot of people off the fence. It's getting people more interested in investing in investment properties. That is. Here's a couple emails that we got, and we love the emails. You can shoot an email to us, Tony or Gordon, at bayarealoansource.com. This email came from unknown. Sitting on a home that's paid in full, but I'm not cash rich. I'm sitting on a home I inherited that's worth $600,000, and I'm looking for an investment property. If you were me, what would your first step be? Keep in mind, my income is pretty low, and my credit score is 735. So the interesting thing, the nice thing about buying investment property is you can have a low income as long as you have the cash. So in this case, the person would have to take the cash out of their house, so they would be increasing their debt. But as long as they qualify for that, and the property that they're buying has a cash flow positive after the adjustments that they make, because it's a new property, you can use 75% of the rents. If it's $1,000 rent, you can use $750 towards the debt on the property, the PITI, principal, interest, tax, and insurance. So if you already qualify for your home, your living expenses, including your other debt, credit cards, car payments, things like that, you should almost automatically qualify on a rental property if it's cash flowing positive. So in this situation, what I think is that is exactly what we talked about earlier. A lot of people sitting on equity on their properties, and these low interest rates are saying, you know what, rents are staying pretty good. People, a lot of people are still looking to, they can't afford a property. There's not a lot of inventory, record low inventory as far back as they can. They've been taking records, and the interest rates are low. Everyone who's buying is buying, and yet you have people who are really interested in getting these properties. I like the idea.
Yeah, it's great. We love these scenarios, but sometimes it's very, very difficult to give a complete answer simply because there's just not enough information. We'd love for that person to have call. We can quiz them and more information. That way we can be more precise with information we give. But the same thing we just talked about earlier. Matter of fact, we're about to close on this client we've been working on since December. The lady has 2 homes. She lives in one and rents the other one out. She's taken enough cash out to pay off the rental property in full. And she's moving that rental property debt to her primary residence. She's, of course, is looking at a rate in the mid 2s. Of course, now when she pays off the rental property, being that she's paying off a $3,000 note, she's actually getting the benefit of $3,000 a month and actually cash flow and income coming in, simply because that the payment doesn't change because the rental property is on a fixed rate payment. So whether you got 12 months of payments left or 60 months of payment less, the payment's still the same. So that was a great strategy that she came up with. And these are the kind of things that we're doing with the cash out. These are the kind of things that low rates allow you to do. It allows you to maximize your benefit, get the cash flow you needed, really put your financial life in order when you have these low rates. That's why it's a great opportunity right now. Tax time is here. Tax plans around the corner. Meet with your professional. Talk to your professional about refinance, and they can give you some good information on what's tax deductible and what isn't. Talk to us, of course. We love the calls. We love the emails, and that's why we're on the way every Thursday from 6 to 7, dishing out this kind of information.
Dishing it out, certainly we are. I like the idea. I always look at rate of return on your investment. And if you're sitting on a property worth $600,000 and you can actually afford to, and you're young enough for it to make sense to get into more real estate, I don't see any problem with it at all. Because right now you're getting 0 rate of return on your investment, which is the equity, $600,000, right? Why not leverage that? That's the beauty about real estate, is the leverage, especially when interest rates are low.
Or the same thing, you can say you have all this cash pent up in the bank. Financial institutions are paying 1%. I'm dumbfounded when I go into these financial institutions. They got, they're proud of it, by the way. Big bold advertising signs, 3 years, CD, 1.222%. It's ludicrous, but people do that all the time because people especially elderly people that are unsure what to do with their money, don't trust anybody. Probably the best place is to trust a bank, even though the rate of return is low, but at least you have safety in your investment. Liquidity is good, but sometimes, especially when you get old, really a lot of things you have to be challenged and concerned about, and sometimes that's the best thing. And those are the kind of clients I assume that they're dishing that information out too, because you're losing money if you factor in inflation
yep.
and saving money at that kind of a rate.
A lot of people, though, Gordon, I believe, are still jaded by the last, the Great Recession. They don't want to get back into real estate because last time we saw everything at highs, what happened? We all have to remember, though, that during that time there were different, I don't want to say unscrupulous, but it was just a different type of lending environment, and we had a snowball effect where the neighbor goes, and they for sale, and it just snowballed the wrong direction after snowballing in the other direction. That's not this case. We have a very strong ownership pool right now under some of the strictest guidelines coming out of, the Dodd-Frank qualified mortgages, ability to repay rule, and everyone who's bought or refinanced since then has used one of these really tight guideline products. So, and besides, there's tons of equity now that we see this, and there's not a lot of inventory for people to go to. So there's not going to be a sell-off like that. So I feel I'm more confident a tremendous amount more confident than I did back in 2008 when everything started hitting the fan.
Well, I think the market made some great improvements, great changes. We always talk about, government not making the right moves sometimes, but I think this is one of the better moves that we've seen government make. Dodd-Frank rule came in, kind of did a separation of space between appraisals and lenders.
It was a little overkill.
It was
overregulation.
But sometimes when things have gone foul, sometimes you got to tighten up things. It's not like tighten the screw. You got to tighten it too tight in order to realize how tight you should tighten it up. And I think over time now we relax some of these rules and we've kind of made changes to make the market very competitive and very efficient. That's why we are today.
Ultimately, what it comes down to is the ability for these investors to sell their loans at A paper, in return giving back to the community and to consumers the low interest rates. That's really what it's all about. And sometimes you have to tweak the guidelines, which was what happened coming out of the Great Recession. We'll come back after this break. You're welcome to call the show 800-516-1220, 800-516-1220, or shoot us an email, Tony or Gordon at BayAreaLoanSource.com. This is Tony and Gordon on the Real Estate Report. We'll be right back on AM 1220 KDOW.
Phone lines are open on the Real Estate Report. 800-516-1220. That's 800-516-1220.
Nighttime in the switching yard.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
You're always welcome to call the show 800-516-1220, as our announcer said. Or you can email us, Tony or Gordon, at BayAreaLoanSource.com. This is very interesting. The FICO score in 2020. This is not just for people doing mortgages. We already know that the people doing mortgages hit an all-time high. I think it was like 750 or something like that for mortgages. But in the average score for the whole United States for people that's not only doing mortgages but other people is 710. And that is a record high. Some of the states that I liked that they break it down by what states have the what state, Gordon, do you think has the highest credit score?
California.
No. What state do you think has the highest credit score?
I have no idea.
And I think I think it's Minnesota. It cut off on the print. The lowest credit score is Mississippi, 675. The highest was like 740, I believe. Yeah, so it's interesting to see how different it is between states. But 710 is a pretty darn good average. It's up considerably from, it is Minnesota. It's 739, and Mississippi is 675. But it's up 21 points from 2010. So that's good to see the average go up. And it's for people who are doing mortgages, that is incredibly powerful that you can get with your credit score. It's the biggest factor in what your ultimate rate will be.
Well, we talk on the show all the time. The last few years, we've made credit score something to work on, something that a target. It used to be a secret before. Matter of fact, many years ago, you go into a place and you apply for a loan. Nobody would ever want to give you a copy of your credit report. It was like a secret. I said, "Where's my credit report? They didn't want to give it to you." But now you have many different options on how you can obtain your credit report. You have many different options on how you can manage your credit score. There's absolutely no reason in today's world for a person to have a credit score below 650. If you take all the factors in regards, if you have bills you can't pay, tax liens, there's always a tool out there, free, of course. A lot of these tools are free. And actually can teach you how to manage your credit score to improve your credit score as time goes on. Because credit score is a snapshot of time. You can have a great credit score today and next month have a terrible credit score because it's a snapshot in time. It's a constant moving model.
You can make all the money in the world and have a 675 credit score and not be able to get a jumbo loan.
Yeah, income and credit scores are not synonymous with each other.
Yeah, it's definitely not. And it is funny that we do see people who make a lot of money. They just don't know their credit. I don't care if you make 50 grand a year or 250 grand a year, you need to be involved in your credit. That's one of the reasons why our credit scores are going up year over year over year, because people are getting involved. That is the direct result of the way that we can communicate with our credit. That's the first thing I would do in any kind of transaction. I would look at my credit. You can go to annualcreditreport.com. You can go to your credit card company and ask them for, the service that they offer. It's usually free. Or you can get Credit Karma, which is also free. And I use Credit Karma. It is fantastic. If you have any questions about credit, we do, when we run credit, we can also do what they call what if scenarios, which can help you see what type of credit score you would end up if you did certain things on your credit. Usually it's paying off a little bit more debt on your credit card, but in a lot of cases that can save you money on your rate. We do that all the time. We'll come back after this break. I'm Tony Mendez. That's Gordon Hines. It's the Real Estate Report on AM 1220 KDOW. Welcome to Call the Show, 800-516-1220.
Got a question? Run it past these guys. 800-516-1220. It's the Real Estate Report with Tony Mendez and Gordon Hines on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
You're always welcome to shoot us an email, Tony or Gordon at BayAreaLoanSource.com, or call the show 800-516-1220. That's 800-516-1220. Affordability issues are going to continue dampening home price gains throughout the year, according to CoreLogic. Their home price index, they say the year-over-year gain was 8.2% in 2020, accelerating from the annual increase of 7.3%. I'm sorry, that was the year-over-year in November. Okay. The company also said that home price growth remained consistently elevated throughout the year, and home sales are expected to finish the year above 2019. Frank Nofat, the chief economist at CoreLogic, said the demographic tailwind has arrived as Generation X and millennials drive housing demand. Lower priced home values increased about 1.5 times faster than higher homes in November, as first-time buyers tend to seek out homes within the lower price range. So we have this massive buying pool out there. You got the Generation X, you got millennials, and they are just buying, and they're making money. They are making money, and it drove up home prices with a low amount of inventory and these low interest rates. But CoreLogic says that even with the stimulus actions that we just saw recently, they predict that home price growth in the United States will go from the 7.5% in the first quarter of 2021 down to 2.5% by November of 2021. Do you agree that? So my philosophy here is I don't think any kind of slowdown in home price is going to affect affordability. I think affordability is going to continue to be an issue throughout the year, with rates kind of creeping up. But, even at 2.5%, people are still having trouble, Gordon, I'm talking about prices going up 2.5%. People are still having trouble keeping up with the down payment just to get to, the 10%, 20%, and so on.
Well, as prices go up, it's hard to qualify simply because the salaries are not raising as far as home prices are concerned. If you look at the median home price versus the average salary increase, especially here in the Bay Area, you'll see that they're not synonymous with each other. So the higher prices go up, that affordability gap begins to widen. If the market slows down and there's more inventory in the marketplace, there's not as many competitive bidding, property stays on the market longer, days on DOM, as we call it, days on the market, then you'll start to see more and more buyers can buy properties, and you'll start to see those affordability factors become a little bit more palatable, simply because prices they're not come down, but they've actually stabilized. They're not increasing anymore. I think that's the key for long-term stability in the marketplace. The market has to adjust and adapt because the market does work off of all cylinders. There's one piece is being fed right now, which is, of course, appreciation, higher prices. This low end of the market becomes a problem, and then you'll start to see market going to tailspins if there's some type of catastrophic financial event that makes the market look the other way and go south.
Like COVID?
Like COVID.
Which didn't really...
But it didn't work for some reason.
It didn't work because that was just a unique event because it pushed people towards housing. In fact, it pushed people out of the big cities into smaller cities and driving prices up there.
Well, we don't know. I don't say we know that COVID hasn't worked yet, because I think we are going to have some turbulence, I believe, from COVID with the market, with people not being paid when the forbearance plans become expires. We're going to start to see some foreclosures. It might be a deferred action. It might be in the second quarter, or be in the early third quarter of 2021, but we will see some remnants of it until the market kind of catches back up. That's why it's very important for these vaccines to get through and this market to kind of really slow down as far as cases are concerned, deaths are concerned, and I think we can get the market back to some normality. The faster we can do that, the less you'll see as far as those deferred properties come to marketplaces as foreclosures.
According to Adam Data Solutions, they researched 499 counties around the United States. Going back 3 years ago, 33% of these counties could not afford, they couldn't afford a house, with their average income, with the average price. That's jumped up this year to 55% of those 499 counties. 55% of those counties cannot afford, the average income cannot afford the average house. So it's jumped up 20-something%, 22% in the last 3 years. I don't see it getting any better. I think that gets up to 60%, even though this same company, or the CoreLogic, I believe, said that we're going to reach 70% homeownership rate in the United States we haven't seen since 2008.
And then, of course, we also didn't talk about the cost of living. We're looking at cost of living increases. I was just looking at a few of my property tax bills versus last year. I mean, some of the tax bills have gone up 7-8%. Rents cannot go up 7-8%. Garbage has gone up. Water's gone up.
Homeowners insurance has gone up.
Everything has gone up. I'm finding now the water bills are higher now because people are working from home than before. Garbage use is up higher on the rental property because people are using more garbage because people are staying at home longer. So it's going to become a really stretching on the property owners. It's not all gold and glitter that people think it is as a landlord, because there's a balancing act that has to take place between rents, cost of upkeep, keeping the property up, and bills. And people never kind of see the whole formula. People just see what they see, and that's part of the problem. I like people to get more involved, understand the marketplace better. I think we become better informed consumers, better decision we can make, a better tenant we can be, a better landlord.
And it's a different analysis now, Gordon. We used to write spreadsheets for investors. We have them, in fact. We can use them. But that there's a lot of, the utility, the maintenance, and things like that, if you're going to pay for it, you got to factor that in now. You got to bump that up another % or two when you're making those adjustments on your cash flow. So I think it's a little bit different. You can't just go and say, I want to buy this house and look at the cash flow. Maintenance has gone up, and it's going to continue going up. And rents, you can only bring rents up so much. Anyway, that's an interesting topic. If you have any more questions about that, you can always email us. This one we got some emails. I like this email. My dad helped me buy a house, and he is on the loan and title. Now he's trying to buy a house, but he's being hit with the mortgage payment on my house. Do I need to refinance the loan to remove my dad? Gordon?
Well, it'd be nice if you could refinance and move your dad who helped you out. But if you can't refinance, you can't qualify on your own without the assistance of your dad. Most lenders would allow, especially if you both parties are on the loan or on title, especially if you live in the property, you have an obligation to the property. We can accept 12-month cancel checks from you that you're actually been making a payment. That way we won't have to burden your dad with that debt. If we can't do that, it's in a consistent pattern. Sometimes we find people are making the payment, but sometimes 1 month they make the payment, second month dad makes a payment. That becomes very convoluted, and lenders don't like to accept that. So you have 12 months cancel checks that you are living in the property, has been making the payment, have some type of financial interest tied to the property.
You can absolve the other person.
We can actually subtract your dad from that payment, and then he can go on and do what he needs to do as far as another property is concerned.
So the answer is no. You don't have to refinance. I mean, you said it in a long way. You don't have to refinance the loan if you can prove that you've been making all the payments, and dad will be absolved of the debt. And this is not just that kind of debt. You can do credit cards and car payments and things like that, as long as Fannie Mae, Freddie Mac, FHA, VA, USDA, they all accept 12 months of cancel checks from the other party, as long as the bank statements you're showing them don't show like payments going over to that person, which we've seen, and that will cancel your loan. But in most cases, it works. It's a fantastic way to. You're not getting around a rule. You just help somebody co-sign. Why would you be penalized for it? But that's the way it is. You're 100% liable unless you can show somebody else is making the payments. That's a really good email. You can shoot an email to us, Tony or Gordon at BayAreaLoanSource.com. We had another. Oh, I wanted to mention. You said something about rental properties. Do you know you can buy a rental property with less than 20% down? You can go to 15% as long as it's in a conforming limit.
Yeah, Fannie Mae does have some interesting products when it comes to buying properties.
That changed last year.
It did. Now there's what we call built-in mortgage insurance within the rate. A lot easier. You don't have to worry about going and getting mortgage insurance come to underwrite the policy. A lot of different things they have done to make the market more competitive, to make market very attractive, which of course have actually fueled the market into higher prices because our business have actually gotten better over the last year or so.
This actually came in the form of an email. We'll get to that when we come back after this break. Again, you can shoot an email to us or call the show. Email is Tony at BayAreaLoanSource.com, or you can call the show 800-516-1220, 800-516-1220. Mortgage rates are still under 3%. Freddie Mac's weekly survey has it at 2.65%. That's up a little bit. It's going to be up a little bit from the market reactions from the elections and the stimulus product. But we can talk more about that when we come back after this break. I'm Tony Mendez, and that's Gordon Hines.
Tony and Gordon are taking your calls at 800-516-1220. It's the Real Estate Report on AM 1220 KDOW.
It just couldn't be, and only a fool
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
You're welcome to call the show or email Tony@BayAreaLoanSource.com or 800-516-1220. 800-516-1220. This is an email from Gloria. We want to buy a new house and take advantage of rising home prices and rents. They want to become investors, but we only have 10% down. Since a rental property needs 20%, we already clarified that if it's a conforming limit, you can do 15% down, believe it or not, and that would be one of their options, maybe take some money out. Since the rental property needs 20% down, how can we just buy the new house as a second home? Whew. Do you want to answer that, Gordon? Because that the big word starts with an F and not the one you think of.
Well,
Yeah, it's fraud. To buy it as a second home and turn it into a rental.
Yeah,
and you have to be really careful about that.
Yeah, it's reverse.
I would rather have you go and get get it up to 15%.
Yeah.
The Fannie Mae, Freddie Mac, and all the other entities out there are really it's the number one fraud out there. It's called occupancy fraud.
Yeah.
You have to be very, very careful. And here's the problem about the business. You are eventually going to run into someone, if you shop enough, who's going to do it for you and convince you that it's the right thing to do.
And a lot of times
And that's what
people
stinks.
don't see it to be fraud but if you go back and look at definition of fraud, you were qualifying for something that you couldn't qualify under the actual current accurate circumstance. So that means you've altered your documentation, you altered your intent, just like saying I'm going to live there versus I'm not going to live there. It's actually mortgage fraud. So you just got to be careful when you kind of check those applications just to make sure you get something.
There's a lender, and I'm not going to say who it is, that will actually do a follow-up and knock on your door if they suspect anything that's weird. They will knock on your door, and if you don't answer and you said it was owner-occupied, got to be careful. Another email came. This was anonymous. I'm doing a cash-out refinance on my property. He has 2.65 today, and I want to get the highest appraisal amount as possible. This is my primary residence. Since I bought it, I built, a shed and a new fence and built a new gate. Would those make the value go up or not? Well, I like these kind of questions because a lot of people don't have, they have no clue how an appraisal is done. They think that, cleaning the house. We've had people who won't let the appraiser in until they clean the house.
Which actually is a good thing, actually, because I've seen appraisals penalize people for not having good housekeeping manners. So I've seen that. Anytime you have anybody coming into your house, the house should always be presentable. I'm dumbfounded by some of the things I've seen and photos from appraisals and how the condition of the property was, especially your lender should have notified you to update you to be prepared. Just like we talked about when we talk about appraisals going out, we always talk to people, make sure the water heater is double strapped. Make sure you have a carbon monoxide detector in there. It depends on the property. Make sure you have a fire extinguisher if need be, because we don't want these appraisals coming back to be subject to, then we got to break the appraiser back out there. It's going to cost more money, delay in time. Just have these things done right, and that's what proper lending do. We prepare people for these things before they actually take place.
Yeah, and I agree. There are definitely things you can do, but I think if you mow your grass, I think you're crazy if that's going to get you a higher value. But it's all about the comps, and you can find we get comparable information that you could always access us, and we can help you figure out what your value might be, or your old realtor that you bought the house, they can run some comps for you as well. That's the most important factor in there. And I wanted to mention too that until the January 31st, Fannie Mae and Freddie Mac are still accepting exterior appraisals. It's called a COVID-19 response appraisal. So if you want to get and you aren't clean, your house is not accessible in the interior, but it looks great on the outside.
Oh, we had a guy that was in the middle of remodeling. He said the house is not ready. He got an exterior appraisal.
Yep.
He said, I'm going to do the work, and sometimes it was a loophole that we actually be able to take advantage of. You can't say it's fraud because they never came in the appraisal. There's no box that say you have to check to say is the house intact. They don't ask for any interior photos, so a lot of times these things that allow
I think
for
they do
pictures
come
to get in.
back and ask for the photos of the water heater and the CO2 detectors.
Okay.
I think they do ask for those. But anyway, they're still available till the end of the end of the month, and they might extend that. Who knows? I mean, COVID's crazy. It's this unprecedented. Lenders are reacting the best they can. In fact, you mentioned something. The Fed and the FHFA and so on has done a really good job in reacting to this round of kind of crisis. You know what I mean?
Yeah, no doubt.
We
I
didn't
agree.
know what to do back in 2008.
Yeah, we
Now
didn't know
we
it.
kinda-
So we've
we kinda
learned.
know.
We've learned from through experiences, and experiences go a long way. One of the biggest, back to the appraisal issue. A lot of times we talk to clients. Clients says, "Well, I got motorized drapes in my house, and I can't believe this guy bought my property in this low." People always take the value of a property to be personal, and I said motorized drapes are great, but they don't really have a resale value as far as we're concerned. So the appraisers tend not to give that a valuation as a plus as far as an extra bedroom, extra
You
bath.
remember
or
the guy
two-car
about the
garage.
solar? The solar.
Yeah.
Remember that?
We had a guy about the solar. He went somewhere else
he
because-
literally went from appraiser to appraiser until, and he paid for him until he got an appraiser to add the value of his solar on there, and he only wanted like 10 grand or whatever, even though he still qualified. He still qualified for the loan with this. The LTV didn't change. He just wanted his appraisal to have the value of it because he spent 20-something thousand on it.
Yeah, and it was we explained to him it's fool's gold, but that's what we want. Customer's always right, so we kind of acquiesced. But he ended went going someplace else because he didn't like what we had to say.
Well, the appraiser, right? It wasn't us.
Well, we get blamed for it regardless.
Did you
right?
call him?
We get blamed for it regardless, so that's
I
why
know.
he didn't like what we had to say.
Oh well, it's all unprecedented. We're doing the best we can, and ultimately, the technology was there. COVID really didn't change anything with the business other than we met a lot fewer people, and people had to wear masks, and some people had their paperwork flying all over their backyard when they were doing signings. Other than that, the industry really grasped the concept of doing everything remotely. Until the end, of course, you have to sign. At least in California. So, with that said, mortgages are still out there. Rates are still good, 2.65% according to Freddie Mac's weekly survey. Of course, higher score that could be better, lower score could be worse. Loan amounts, you can cash out, things like that. You're welcome to give us an email with any questions. Tony or Gordon at BayAreaLoanSource.com. That's Tony at BayAreaLoanSource.com. Thanks for being with us. We'll be back next week.